It's quite refreshing to open the news and see central bankers finally acknowledge what you've been saying for years. It doesn't take a genius, however, to figure that stocks have risen because of central bank intervention. Therefore, they would come down if the Fed reduced its balance sheet. It's a no-brainer. Hang on to your 7 shares of Amazon. It's going to be a bumpy ride. You came here for the truth, so let me unveil that for you. Today, we are going to look at what's going on with the central bankers. We'll talk about the Fed, inflation, currencies, and so much more. Let's begin with this article out of Bloomberg. Indonesia's new central bank chief joined his counterpart in India, calling on the Fed to be more mindful of the global repercussions of policy tightening amid a rout in emerging markets. I've been covering it here on the channel that emerging markets have definitely seen a slower pace recently and some declining. In his first interview with the media, he said basically that the Fed's reduction in their balance sheet was a key issue for central bankers across emerging markets. And as well as in India, they said, arguing slowing the pace of stimulus withdrawal would support global growth. Okay, that's two right there, but essentially showing us that it's not just those two, that they all agree on this. We know every country must decide their policy based on domestic circumstances, but you have to take account your actions and the impact of your actions on other countries, especially the emerging markets. I'll say this right now. If the Fed reduces its balance sheet, it's going to affect the whole world. It's clear to me. I've been saying that constantly. And now we have central bankers around the world agreeing with me. Thankfully, they've finally come around. Somebody's acknowledging it, at least. All right, moving on. The dollar bond market will face a crisis unless the U.S. Federal Reserve slows down the unwinding of its balance sheet. That's according to the Reserve Bank of India's governor here. Given the rapid rise in the size of the U.S. deficit, the Fed must respond by slowing the plans down to shrink its balance sheet. If it does not, Treasuries will absorb a large share of the dollar liquidity that a crisis in the rest of the dollar bond market is inevitable. Don't screw up, he said. This is going to be, obviously, as they use their words right here. This is a central banker's words. Turmoil. Something I talk about all the time. Well, they've been increasing interest rates. They've been at a fractional pace. They've been reducing their balance sheet. They've been doing this at the slowest possible, in the slowest possible means, yet it's still causing central bankers to go out there and beg, don't do it. Well, we're going to see what happens. The upheaval stems from the coincidence of two significant events: the Fed's long-awaited moves to trim its balance sheet and the substantial increase in issuing U.S. Treasuries to pay for tax cuts. So we'll see how this all unfolds. I got some more information here that I wanted to get into. Speaking of central banks, the euro swung higher after two ECB officials on Wednesday indicated that the bank's meeting on June 14th will cover the timetable for the unwinding of its $2.5 trillion euro program of bond buying or quantitative easing. All right. So they're going to reduce their balance sheet. Wow, 2.5 trillion euro. That probably won't go over so well. I mean, I've been hearing about this. It's been a story. And it starts with once upon a time in Europe. However, doesn't end happily ever after. They cannot reduce their balance sheets without causing a crisis. It's not possible. There have been billionaires and well-connected individuals at the very top saying that. Now we have central bankers saying that. And actually, if I remember correctly, somebody at the Fed, one of the Fed presidents, said that they have no idea what the effect of reducing the balance sheets will do. The Fed themselves, that's why they're going so slow. But they're the ones who know everything, apparently. We'll see. You have a situation in Turkey that's going on right now. And by the way, I've got people from India, from Turkey, from South America, from Europe, all over the place that have been asking for videos on them. That's why I'm covering all of this. I think the whole global economy is important, okay? So if you're from those individuals from Turkey asking me to do videos, at least I'm including some information when I can. India, same thing, okay? I'm trying to cover information all over the world. This right here, everybody knows what's happening in Turkey right now. Their currency has been significantly devalued. We have seen to say it's devalued is really understating it. However, recently the central bank had increased their interest rates quite a bit here, from 16.5% to 17.5%. They're worried about what's happening here with this upsurge in inflation. They are concerned about it, and so they should be. They have to instill more security. They're trying to increase interest rates and doing that, but look at what happened in Argentina. They had to increase dramatically in a short period of time, and it didn't really give the market any sense of stability at all. Venezuela, don't even get me started. So we see this in a lot of developing nations, in fact, where they have to really, really ramp up the interest rates in order to stop inflation. It usually doesn't work, but at least it's something that they can try. And I like to look at it and pinpoint it and see what happens. This right here shows us that we have never seen. I've shown you this before, but it continues. So we're looking at the comparison between the tech sector and the financial sector, and we've never seen the tech sector this high since the dot-com boom and bust. So it is important, there's no doubt, but are you suggesting for the individuals that say that, look, tech is so important these days, it's pervasive, it's everywhere, Amazon, Apple, so on. It's more pervasive today than it was back in the year 2000. There's no doubt about that. But is there the suggestion that financials are not important? They're equally as important. There's more financial companies, the bigger financial companies today than there was back in the year 2000. They've grown. Their profits have grown. The companies have expanded. They're intertwined with government more so today than they were 20 years ago. But this is what we have to look at. Now, I think that just showing this doesn't really tell us anything. But what I do see here is that following the dot-com boom, we had the bust. And I don't think it would be to this degree, definitely. I think it would be a lot more even in the next crisis that we experience. However, we have to be worried about imbalances. And that's imbalances in the, financially, what the government has, what your particular state or region or province or city has. We also have to look at the imbalances in the stock market itself. Are we too overweight in something? That's for sure. There's no doubt about that. Nobody would disagree with that. And this right here is just trying to show you how it has been developing over the last little while. This is Stockman, David Stockman. He's an interesting character, has some very good things to say. Doesn't mean I would agree with him on everything. I do agree with him on his statements here. These tax cuts are going to add to the deficit in the 10th year of an expansion. It's just irresponsible crazy. It's all going to stock buybacks and M&A deals anyway. That doesn't cause the economy to grow. It's just a short-term boost to the stock market that doesn't last. That's practically exactly what I have been saying. So that's really what I wanted to point out, that other individuals out there are making the same judgment calls. And what's funny about this article out of CNBC, look, they're saying this. He's made bearish bets in the past and they've never materialized, okay? They've never materialized. He says right in here that he doesn't know when it's going to happen. He's just pointing things out, and that's what I'm doing. I'm just saying, look, I got some information for you to check out. Take a look. There are some huge surprises lurking out there because we've had 8 years of monetary expansion that is just off the charts of history. And that's exactly my point. The central bankers don't know what's going to happen. So why would any of us know? They literally don't know what is going to happen if they bring down the balance sheet. And then very quickly here, talking about an emerging market. Developing nations here have really been struggling more recently, and Venezuela it's very clear. The situation has just gotten worse and worse. It's not in the news every single day. However, I wanted you to look at this. Venezuela's central bank in April paid $172 million to U.S. bank Citigroup to recover part of the gold it had put up as a guarantee in a swap operation, according to two sources familiar with the situation. Citibank got paid. The policy is to recover the gold. Very interesting here. You could see that their gold reserves have been declining quite a bit. I expect that this will go down to nothing eventually. It shouldn't surprise you. I know it doesn't surprise anybody these days, but they have no money left. So they're dipping into their gold reserves. I'm sure they've got a lot of gold underneath the ground, but that doesn't really help them this time. They'll have to basically make a deal where they can look at a proven site and have a company come in and do it for them, and they'll basically have to sell off the country's own resources. That's really their only safety, if you want to put it that way. But of course, in the long term, it's not good. And last but not least, Amazon considers offering home insurance. So this is one company that's out there that's just getting into everything. They're sitting on big piles of cash. They need to get into everything, apparently. So this is one more possibility right now. There's nothing concrete. There's nothing guaranteed right now. But I just wanted to bring it to you because I think it's important to look at the big corporations, what they're buying, what they're doing, who they're talking to. And then we could be able to address the future situations that will occur because of it. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a thumbs up, it helps to support this channel, so I do appreciate that very much. And last but not least, if you found this video informative, I know you'll find my books even more informative. These are the books, these contain the information that they never taught you in school. You never learned financial education. I know I never learned financial education, and so I read countless books. I listened to the audiobooks, I listened to the speeches, I listened to the seminars, I went to seminars, I did everything I needed to do to put this information together, brought it and condensed all of the years of my experience, all the years of my education, and condensed it down into 2 books. The average person spends literally thousands and thousands and thousands of dollars on their education. They never learn anything about finance, don't learn how to protect their money. And so in these 2 books right here, the first one $20, the second one's $10, you will learn more than what everybody will learn in their time in school. And that tells you something right there. The people who are supposedly taking advice from don't really know much. It's quite sad. So if you want to check them out for yourself, you can flip through these books at Amazon. There are links in the description below. Take care.